Welcome to the video on the $5,000 rent shock and why renting might be financially dangerous over the long term. Today we will unpack how compounding rent increases can quietly destroy your budget, why ownership can act as a hedge against housing inflation, how location shapes your risk, and what strategies can protect your future. Let's get started. The core idea is that rent tends to rise over time due to inflation and market dynamics. And because those increases compound, the long-term cost of renting can become extremely high. By contrast, with a fixed-rate mortgage, the principal and interest portion remains fixed, even though taxes and insurance can rise. This stability in principal payments can act as a hedge against ongoing housing inflation. In this video, we will compare these paths, quantify their impact, and outline strategies to protect your financial future. Here is the roadmap for today's video. First, we will examine the compounding rent problem. Next, we will explore how ownership can be an inflation defense. Then, we will discuss how location risk varies across markets, particularly coastal cities and job hubs compared to declining markets. After that, we will outline the costs that owners still face, including property taxes and insurance. We will then provide a practical action plan tailored to different market conditions. Throughout, we will include quizzes to reinforce key points, and we will finish with key takeaways and a concise summary. Disclaimer: this content is educational and informational only. It is not personalized financial, legal, or tax advice. Markets vary significantly, and your circumstances are unique. Always conduct your own research and consult qualified professionals before making major housing or investment decisions. Rent compounding follows a simple formula. New rent equals old rent multiplied by 1 plus the annual percentage increase. Starting at $2,100 per month, a 3% annual increase leads to approximately $3,793 by year 20. At 4%, the rent is around $4,601 by year 20. At 5%, the rent can exceed $5,570 by year 20. As a result, even relatively modest increases can have dramatic long-term effects. Meanwhile, wage growth often trails these rates, which creates a persistent affordability squeeze. This table shows estimated monthly rent over time, starting from $2,100, assuming annual increases of 3%, 4%, and 5%. After 5 years, rent rises to around $2,434 at 3%, $2,555 at 4%, and $2,680 at 5%. After 10 years, it increases to approximately $2,822, $3,109, and $3,421 respectively. By year 15, it reaches roughly $3,272, $3,782, and $4,366, and by year 20, it grows to about $3,793, $4,601, and $5,572. These are approximations, but are sufficient to illustrate the compounding effect. With a fixed-rate mortgage, the principal and interest portion of your payment remains constant for the term of the loan. This provides stability even when the broader housing market experiences inflation. However, homeowners must still account for property taxes and insurance, which can rise 5 to 10% annually, depending on the jurisdiction and insurer. Importantly, each mortgage payment builds equity, which can help protect you from long-term housing cost inflation and can contribute to net worth over time. Homeowners must plan for rising non-mortgage components. Property taxes in some localities have been increasing between 5 and 10% annually, though this varies widely. Insurance premiums have been climbing, especially in areas exposed to climate risks such as hurricanes, wildfires, or flooding. Maintenance and any homeowners association fees also trend upward with time. Nonetheless, even as these components increase, the fixed principal and interest payments anchor the overall housing cost profile, which contrasts strongly with entirely variable rent payments. On the renting side, your housing cost is fully variable and tends to increase annually with the market, and you do not build equity with these payments. However, renting offers greater flexibility and lower upfront costs. On the owning side, you gain fixed principal and interest payments that stabilize the core of your housing costs, and you benefit from equity growth as you pay down the loan and as property values may appreciate. That said, ownership exposes you to rising taxes, insurance, and maintenance costs, and it typically requires significant upfront costs while reducing mobility. Quiz time. If rent starts at $2,100 and grows at 4% annually, which is the closest estimate for the rent in 20 years? Option A, $3,800. Option B, $4,600. Option C, $5,600. Option D, $6,200. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $4,600. At 4% annual growth over 20 years, $2,100 times 1.04 to the 20th power is approximately $4,601. Location significantly shapes your risk profile. Coastal cities and high-demand job hubs experience greater volatility and premium pricing, making 5% annual rent increases more plausible. By contrast, stable or declining markets may see more modest increases, flattening, or even occasional declines. Local housing supply plays a crucial role. Markets with robust construction tend to experience more moderate rent growth because increased supply alleviates pressure on prices. Here is an action plan. First, quantify your rent trajectory by modeling 3, 4, and 5% annual increases over the next decade or two. Second, stress test your budget by considering temporary spikes of 8 to 10%, which can happen during tight markets. Third, price out ownership and compare fixed principal and interest payments with the rent you expect to pay in 5 to 10 years. Fourth, evaluate location by targeting submarkets with active new construction and balanced job growth. Fifth, if buying, build reserves to handle rising taxes, insurance, and maintenance. Sixth, if renting, negotiate renewals and consider longer terms to capture incentives. Finally, advocate for increased housing supply through zoning reforms and support for construction, as more supply is the structural solution to moderating rent inflation. This decision flowchart begins by asking what your current housing choice is. If you rent, you first project future rent under 3, 4, and 5% annual increases, and then compare those projections with a fixed principal and interest estimate for ownership. Next, you assess whether your budget can withstand future rent. If the answer is no, you consider buying or relocating to a supply-rich submarket. If the answer is yes, you continue renting and attempt to negotiate a longer-term lease. If you own, you evaluate rising taxes and insurance at 5 to 10%, then stress test your reserves. If the outcome is not sustainable, consider refinancing or relocating. If the outcome is sustainable, you hold the property and continue to build equity. Throughout, the chart emphasizes the effects of local housing supply and wage growth on your decision. Second quiz. Which component of a fixed-rate mortgage payment typically stays constant over time? Option A, property taxes. Option B, home insurance premiums. Option C, principal and interest. Option D, maintenance costs. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is principal and interest. In a fixed-rate mortgage, principal and interest remain unchanged over the loan term, whereas property taxes, insurance, and maintenance costs can increase over time. Let's clarify the math. The compound growth formula for rent is R sub n equals R0 times 1 plus G to the power of n. For example, with a starting rent of $2,100 and a 5% growth rate, year 20 rent is approximately $5,572. Even at 3 or 4%, the long-term effect is material. A useful approximation is the rule of 72, which estimates the time to double by dividing 72 by the annual rate. At 4%, rent doubles roughly every 18 years. For budgeting, compare your future rent trajectory to a fixed principal and interest payment, plus rising taxes and insurance. Also, run a stress test by assuming short-term spikes of 8 to 10% for a year or two. This timeline depicts 3 rent growth scenarios over 20 years, starting at $2,100. 3%, 4%, and 5% annual increases. Each track highlights values at years 0, 5, 10, 15, and 20. The chart also annotates how wages often lag behind housing inflation, and how compounding creates increasing pressure on household budgets over time. The structural solution to rising housing costs is increased construction. When new housing supply is added, It helps moderate rent growth by easing demand pressure. Achieving this requires zoning reforms and improved permitting processes to allow supply to meet demand. The goal is not to panic, but to plan strategically at the household level, while advocating for policy changes locally. Key takeaways. First, compounding rent can significantly increase costs over time, turning $2,100 into roughly $3,800 to $4,600 at 3 to 4% and around $5,500 at 5% after 20 years. Second, fixed principal and interest payments and ownership stabilize the core of housing costs, even as taxes and insurance rise. Third, location risk varies considerably, with coastal and job hub markets generally more volatile. Fourth, you should plan ahead by modeling scenarios, stress testing your budget, and comparing renting versus owning over a decade or more. In summary, rents rise, and those increases compound, which undermines long-term affordability. Ownership, when appropriate for your situation, can hedge housing inflation through fixed principal payments and equity building. Your best defense is to plan ahead, compare scenarios, and support policies that increase housing supply to moderate future rent growth. Thank you for watching. If you found this helpful, please like the video, share it with someone who needs it, and subscribe for more content. Tell us in the comments what your market is experiencing. Are rents cooling or heating up? And how you are planning for the future.